Hey everybody, Jay Young here with the Jay Young Show. Today, we're gonna have a great show today, but I want to talk about the show a little bit. This is we talk about healthy, wealthy, wise. We talk about our faith. We talk about what's energizing people today. How can I help you be a better person? I'm not a motivational guy because there's a lot of people out there that are motivational. What I want to do is bring in life experiences. I want to bring in people that have done it, people that know it, people that and there's nobody better. I'm joined today by Ben Carmona. Hope I said that right, Ben.
Perfect.
He's a managing partner at Perch Wealth, over 20 years of experience in the financial services and real estate investment world. Ben's an expert in 1031 exchanges, which I look forward to talking about that. Delaware Statutory Trusts, and also a variety of alternative investments. So, Ben, welcome to the show.
Thank you, Jay. Pleasure to be here. Thank you for having me. And you sound pretty motivational to me.
Well, I appreciate that. I talk about that. I think, to make you feel good or whatever. And there's people that have been doing this for, decades. And I was fortunate when I was 20 to start listening to Zig Ziglar, and selling fire alarms door to door in West Texas, and there's just so much material. I don't know if I could really create a lot of new material every week or every episode. So I'm just like, hey, you know what? Bring you life experience. Nobody's ever talked to, Jay Young has never talked to Ben Carmona before.
That's right.
Man, we're going to have some new stuff today. It's going to be good. It's going to be,
Yeah, I hope so.
It's going to be inspirational, motivational, educational. Who knows all this stuff? You know what I'm saying?
Right.
Man, we're going to have a good time. We're going to have a good time. So tell me just brief, what's a 1031? That's a tax code, I guess?
Absolutely. 1031 exchanges, it's one of the longest standing tax codes out there, and I would say the most powerful. And it essentially allows investment property owners, right, those who own rentals or any sort of investment property, to defer paying taxes on the gains upon selling, as long as they use the proceeds from sale to buy other investment property.
Like kind.
Right. So 1031 exchange allows investment properties to defer taxes when they're selling their properties, as long as they continue to invest in investment property.
Yeah. Okay. Yeah. And I remember the term like kind, and people in the oil and gas business have kind of stretched that like kind summary or definition a lot because 10 years ago, 15, I don't know. We did some 1031 oil and gas where we would take literally the minerals of a lot of wells that were drilled in other areas. And we did, our first project was 30 producing oil and gas wells with 30 brand new locations that were going to be drilled in the future. And we put it in a 1031 mineral package. And then people said, well, I got a 1031, and they may do a certain amount into another, from one apartment complex to the other, and then also do some minerals in there, or the whatever's left over. The best thing I like is, like, we sold a building that we owned in our business, and after 5-10 years or however long we owned it, we had a profit. So instead of putting that money into my account or business account and paying taxes on it, I could put it with a QI, qualified intermediary.
Qualified intermediary. Yeah.
Are you a qualified intermediary?
No.
Okay.
No. I'm an advisor. I help clients that are selling their investment property and looking to find other replacement property.
Right.
I get involved there and help them source. And I'll tell you, Jay, your background in oil and gas far exceeds mine. I've known about it for many years, but as an advisor, being in the business, but it was a sector or asset type that I never embraced up until maybe 4 years ago, when I met a couple of gentlemen that were in the mineral rights, and we do a lot of 1031 exchange business, directly into those mineral rights, along with other opportunities.
Yeah. That's good. I don't really believe in it. I'm sorry. But this is me, Jay Young, speaking, and I'm not trying to put down anybody that you're talking to at all, because it's got its deal, right? But when I was doing it, our returns were 20-25%. I could find minerals. That's how old I am. All right. I could find minerals. Me and Scott Noble Royalties, we found royalties that were 15, 20%, 25%. I mean, I remember going to Riverstone, one of the largest, asset-backed companies with billions of dollars in assets, and he was like, "Hey, if I could be you, I'd want." Pierre said that. If I could find what you're buying, he said, I could change the world. And I said, well, it's going to be good as long as it is, but then it's not going to be. I mean, so it got so expensive that everybody got into it, and all of a sudden the returns went from 15 to 20. We were buying it for literally, I mean, we could buy it for 3 to 4 years, return. So I get all the clients' money back in 3 years. But that was 20 years ago. 15 years ago, it started going the other direction. Everybody got in the business, and all of a sudden, now your returns are 4, 5, 6%, even if they're there. And if you're there, then and I'm not trying to be negative on part of your business. I'm sorry.
It's educational. It's dialogue. Yeah.
I've already got my money, and I don't want to have to get my money back in 20 years. You know what I'm saying? It's like if I get a 5-year 5% return with minerals, because majority of the minerals are not necessarily, you're not going to scale them up and sell them. So you're just going to have this, and it's going to be a cash flowing asset, 5, 6%, 8%, whatever. You're going to buy the minerals, and I couldn't buy them. I couldn't buy them and turn around and sell them because I got overhead. I got to make a little bit of a profit. I got to whatever, and then manage them and do that. So it was kind of a hard deal. So it was kind of a hard for royalty people to sell the product. Now, it sounds great, and it's a long-term income. You don't do anything except go to your mailbox. We've got a lot of royalty, and I love it, and it's something that's obviously, worth it because you don't have to do anything because you're a mineral owner. But, man, it's hard to get a good return for that. So I got out of doing 1031s. I got out of doing 1031s. I thought, if I could do a 1031 value add project where I could buy the royalties and drill wells, increase the value, and sell like an apartment complex, now you're talking. Now you'll turn around the industry, and we've worked on it, but I haven't completely got that figured out yet. But
well, if I just say, and then I don't know where you want to take the call. We can go anywhere, but we work with one group almost exclusively, and they're out there. They live in Texas, near the Permian Basin, and they put together these offerings that are made up of a bunch of different parcels in across counties. And so, like, for example, the last offering that we recommended and that our clients are investing in, that I invested in personally, it consisted of like 50,000 acres of oil and gas rich land in the Permian Basin. There's 12, top tier 1 operators, 400 existing producing wells, and then, a tremendous amount of growth potential in terms of, digging new wells.
Yeah.
And something like that can offers our clients starting at 8%. You've got 35 years of shelf life in them. They're highly tax efficient, as you know. And so what we've seen with this company, if it's that 400 existing producing wells today, in 2 years, it's not inconceivable for there to be over 500.
Right.
And that's where the growth component or appreciation component could come into. But again, our clients are really buying in for the cash flow up front. So I'll stop there, and I'll give you a background of the investors that we work with, and kind of build a story around what we do and why it makes sense.
Right.
But I'll let you
Yeah. Well, no, I mean, that's a great return, 8%. If the asset value, you can sell the asset value in the future, 3 to 5 years. If you put 100 grand in, you're getting a 8% return, goes to 10, 12, 15. But then all of a sudden you can sell your return for 100 grand. You can sell that in 3 to 5 years. That's just hard to do. I mean, and now I didn't like the royalty because it was like a hard sell. And we also got into a lot of natural gas when natural gas was $8, $9,
Right.
$10. And then all of a sudden, man, we got returns of 15, 20. Then all of a sudden it went from there to 3 to 4. And there was no new drilling because commodity price. So it's really commodity price driven on future activity, which is, that's just a part of the game. But also, I was just going to say, royalty's one thing, but 1031's another, right? So 1031's another good, it's a good, you're getting more return there because you are doing a 1031, you're not paying taxes. Whatever your capital gains is, it's another benefit. But
and it's you said it, it's a commodity, right? So when we build portfolios for these exchange clients, being tied to a commodity is fantastic from a diversification standpoint, right? You got real estate, multifamily, you got self-storage and healthcare. Well, mineral rights, have that commodity there. If you're worried about inflation, if you're worried about the world going to hell in a handbasket, with all the chaos and the wars around, like that's a great piece to have in your portfolio, right? It's a stabilizer.
Absolutely. But you can also do it with drilling too, which we do drilling. We do more drilling prospects is what King Operating does, which I mean, majority of the people that are here know that I just have drilling programs that we do. We're doing frac sand. We have our LP that we have right now, and we're drilling in different areas like the Bivens Project, Amarillo, 60,000 acres. We've got projects in Hockley County that we're drilling. We've got Eastern Shelf projects, and also a frac sand business that we're starting up, which is huge. It's the write-offs are, but you get 100% write-off on that, 80, 90% the first year. You get a write-off, but it's different than your 1031. But still, you get write-offs, and
fantastic.
Our returns. I look for the 20 to 30% returns. So you get the write-off, and then you get the income, but you also get the monthly income is what we like, diversifying with a drilling. But you get the write-off, and you get the income. But also too, I'm looking to grow that asset because a lot of times in royalty, it's like I don't say there's not a market for it because there is a market for royalties, but normally it's hard to sell that asset in the future of royalties because you're buying, the 400 wells that you're buying today, it's a declining asset. That's why we decided to put the frac sand business inside our fund because, man, it's an increasing asset. So you don't have that total decline. You have some type of growth, even though you're drilling new wells, but you're also having a frac sand business. So it's totally different. This isn't about me, Ben. This is about you. So let's. I could talk about that forever, but let's talk about your experience. What else are you doing? How long have you been doing the royalty? How long is that? Have you been doing royalty?
Yeah, about 4 years now. Yeah, about 4 years.
About 4 years,
and I've invested in. I try to invest in every one, but I've invested in 5 or 6 different royalty offerings thus far, and it's been fantastic for our clients. It's not like there, as I mean, there's fluctuations in the income based on getting the operators into pay status and getting the distributions processed each month. So it's not like a triple net lease product or investment where it's the same old or systematic checks each and every month, same amount. But the royalties have been fantastic for us thus
That's
far.
Awesome. That's awesome. Good deal. Talk about real estate a little bit. What's your experience in real estate, or what's the biggest things that you've learned in real estate, or tell me some good experiences there, and bad, good and bad.
Yeah, it's right. It's across the board. Well, I'll just tell you. I mean, so I've been in the private real estate syndication world for almost 20 years. You know, right out of school. Of course, I started in the basement doing nothing, but worked my way up, and so um, I represented big institutional companies that were assembling um, investment products to distribute through financial advisors and wealth managers. And so I was working with advisors, wealth managers, and then also involved in acquiring real estate, doing underwriting and due diligence, and structuring all sorts of private syndications, whether it be private real estate investment trusts or business development companies or Delaware Statutory Trusts, TICs, funds, you name it. And so I lived in that world for a long time. And then just 4 years ago, or a little over 4 years ago, I hung up my boots from the investment syndication side and became an advisor representing clients and recommending or the same, not recommending, helping them with the same investment vehicles that I was building for 15 years.
Okay.
Um, right. So my clients are, excuse me, baby boomers, seniors, 60, 70, 80, 9 years old. These folks have, worked hard to acquire and manage and real estate investment portfolios for
Mm-hmm.
20 to 50 years. And they're at a stage in life where they are they are tired of active management, right? They don't want to deal with the toilets, trash, tenants anymore.
Right.
And they're hoping and dreaming and praying of a solution that will allow them to sell their investment properties, avoid paying taxes, and get into a passive situation where they don't have to manage and they can collect stable, predictable monthly income.
Right.
And
Right.
that's where the 1031 exchange comes in. So that's what we specialize in. But and the last thing I'll say is other tax mitigation strategies, like you just mentioned,
Mm-hmm.
the drilling, fee simple donation investments. We're all about tax mitigation, but most of our business and most of our clients are on the 1031 exchange front.
Okay, so that's kind of where they come from, or people that are looking to do 1031s. That's a great man. There's a lot of 1031s. I didn't have any idea how big that market is. Man, there is a lot of people looking for 1031s. They're looking for replacement property. So when you do one, it's like when you sell the prospect or sell your, like when we sold our building, uh, we could put that money in our bank account and pay taxes, or we could put it with a QI and say, hey, here's $1 million. I'm gonna put $1 million in this account with a qualified intermediary, and then I have 45 days. I have 45 days to replace that. So I don't have to close in 45, but I have 45 days to identify 1, 2, 3 properties. And so at that place, I go on the hunt and I go, all right, well, I need to put this $1 million somewhere. Where do I put it? And then I can also use debt at that time. It's just the equity portion, right? Is that how it works?
Yeah, I mean, you know it. Yeah, so 1031 exchange, it's an amazing tax mitigation vehicle, right? You can defer paying taxes, and honestly, what we say is swap until you drop. So you can continue to exchange or swap, exchange, and then defer all these taxes, and when you pass away, your beneficiaries inherit the assets at a stepped up basis. So I mean, it's an amazing vehicle. But to your point, Jay, we're blessed. The IRS blessed us with this code, but they don't make it easy,
Yeah.
right? I mean, so you're limited to 45 days to find suitable replacement property, just from an identification standpoint,
Mm-hmm.
which isn't easy to do for most people, right? I mean,
Right.
unless you have the time, the wherewithal, the expertise to go out and find suitable replacement properties and do the due diligence and line up your financing, and all these things have to come together for that to happen. They're tough, but I mean, they're doable. They've been happening for 100 years. They're happening every single day, but it's not a cakewalk. And so again, the offerings or that we provide are turnkey, meaning somebody sells a property today, they could, in theory, reinvest into one or more of the investments that we have available today. And the investments we have are institutional quality properties and maybe $100 million multifamily project in Dallas, Texas, 95% occupied. It's managed by a big asset manager like Cantor Fitzgerald. And the investor could literally exchange directly into that within a week, satisfy their exchange, defer the taxes, and start collecting, monthly income.
Right.
And then the debt, Jay, to your point, you brought up debt. Part of the 1031 is, in order to defer all taxes, you need to redeploy all of the proceeds from sale, and you also need to acquire, real estate of equal or greater value. So just to give you an easy example, if you, Jay, own $1 million property, $500,000 of equity, and you got a mortgage of $500,000, you sell that property, you pay off the mortgage, of course, $500,000, and your $500,000 of equity goes to that qualified intermediary, which you referenced early on in the call. And so that $500,000 you need to buy $1 million worth of property at least with that $500,000.
Okay.
So in order to do that, you can either, kick in another $500,000 of equity, which most people don't do, or you're going to go to a bank and get a loan and buy a property of at least $1 million of value or more.
Right.
And debt is hard to find today. And even if you can get approved, it's not very attractive. Right. And so in the offerings that we specialize in, the debt is already included. It's already tied to the asset. It's all non-recourse, and investors can walk in with $500,000 of equity in this example and assume the leverage that they need to satisfy the exchange with.
Okay. So these different funds, like I'm in Night Vest with David Moore. I don't know if you know David or not, but they manage 60, 70,000 doors. They're big here in Dallas, but under the radar, which David likes that. But I could just put a 1031 into his fund and satisfy that 1031.
Yeah, it sounds like it's like a 721 UPREIT kind of situation where he's got a REIT and he's absorbing your single families, and those are big today too. 721 UPREITs. Yeah.
Okay. I didn't know that. I didn't know if you could just put it into. I've got another guy that's I'm investing with, Manny Ibarra. He's a commercial real estate guy. He has a fund, and I could just, if somebody said, hey, because I did interview. I've interviewed a few people with 1031s, and Donna Cowdery. I did interview her at NAPE. It should be on the Jay Young Show somewhere, but she's a qualified intermediary, and her company's called 1031 Ventures. Corey Cheek has been a good friend of mine for a long time, and he's an attorney, and he's there at qualified at 1031 Ventures, but they're a qualified intermediary, which is that person I was telling you. Money goes into their account, and then they split the profits or something with you while you're trying to find a like kind exchange, whether it be royalty or whatever the case may be. She was talking to me about. I said, I would love to do drilling or have a drilling project because, see, I think personally that apartments are like a 1031, where you do a like kind exchange where you're increasing the value. That's all an apartment complex is. I'm just buying an apartment complex and I'm spending X amount of dollars on it, and then I'm painting it up, or I'm fixing it, I'm value adding it, and that's what drilling is. So that's when I was talking about putting together a good drilling prospect with a 1031 like kind exchange. And then she said, Well, now that can work, but you have to do X, Y, and Z, and man, those those did not connect, and I need to go back and connect with her to see, because I know that would be an incredible drilling prospect, or a 1030, because there's no increase in value better than drilling. Period. I mean, there's just not, but you have to have the money to do it, and if you could design, or if we could design some type of a product that you could do. And I mean, this isn't about me again. I'm sorry, man.
No.
Man, I tell you, I know we're just kind of brainstorming and talking, and that's what the Jay Young Show's about, right?
Yeah, no. And I'll just say that, like back to the like kind, it's got to be real property ownership, and that's I mean, that would be the issue with drilling, is like, you're not investing in real property. A drill is more personal property, right? Now, if you could somehow, actually, I don't see how that could work. But who knows?
Yeah, she said, and what Donna said is that the property can go into the 1031. The property could go into the 1031 because this is like a royalty package, right? I mean, we did this to where we had literally tens of thousands of wells across the America, and we had to go into every single county with every single person, and it's like you have to assign each person in each county with each well, and you do that. You're doing it 50,000 wells or whatever, how many wells? Let's say 400 wells, like you have. You have to have 400 wells, and if you have 20 clients, that's 8,000 different assignments, and then but you have an assignment of that interest in that county, which that satisfies the 1031. Well, it's the same thing with drilling. If the 1031 owns the acreage, I could tie up, let's say, that 60,000 acres that we have in Amarillo, and I could say, hey, let's just put together 5,000 acres and put it into a 1031. I may be able to do something like that, and then maybe the people. But see, I don't see how both of them couldn't be a part of a 1031.
Yeah, I agree. Look, if you're exchanging into that real property, right? Yeah. And then you're taking advantage of the drilling. I mean, that's just an added benefit. Absolutely. Sounds like it could be great.
I will look at it. I know that, man. Yeah. I hate to say this out loud, but Ryan Real was our attorney with taxes. He put together 5 years ago probably a 1031 drilling program that when COVID hit, it failed, but he passed a couple of weeks ago. And I mean, I hate to hear that from Ryan Real and his family, 2 boys. Oh, what a delightful guy. And he was with us for 15, 20 years up in Detroit, Michigan. But he passed, and he was really I talked to him about it, and I said, hey, you know what? What's the difference between an apartment complex? When you buy the apartment complex, you're buying the address, in the courthouse. You're doing the same thing with a farm out or something with real estate or oil and gas, and then you're bringing in oil and gas drilling to increase the value, just like you are if you paint it or put another story on a building, or value add. What's the difference? And anyway, I need to have some more conversations around that.
I mean,
I love it.
Absolutely. I mean, look, in the spirit of drill, baby, drill, right? Like them or hate them. I mean, we're in a new administration and a new age here, and there's a lot of focus and excitement around energy in general, right? And it seems like it would be a great time for you to really explore that right now.
Yeah, absolutely. I need to find a new attorney, or I need to talk to them about that and see what that is. So what's a DST drilling? We call that drill stem test in the old business, but and that's a drilling deal. But in the 1031, what is the Delaware Statutory? What's the difference in that?
Right. Yeah. No. So DST, a Delaware Statutory Trust. So you got the 1031 exchange code, right? It allows you to sell investment property and buy other investment property and defer taxes. And then there's a DST is a structure. It's an entity. It's a trust. and it provides a pathway to satisfying an exchange, right? So if you sell your property and you can go out and buy another investment property on your own, that happens. That's the majority of exchanges today. Or there are Delaware Statutory Trusts. So briefly, DSTs were created in the 80s, right? They weren't set up for 1031 exchange purposes at that time, but it's a trust whereby you have one trustee that manages the trust on behalf of up to 499 beneficial owners.
Okay.
Right? So when you take this trust and you apply it to real estate, it creates a fractionalized ownership situation.
Okay.
Right? And in 2004, under IRS code 2004-86, the IRS came out and validated this structure, this form of ownership as real property, and therefore eligible to satisfy exchanges. So just think, I mentioned the $100 million, 400-unit multifamily property in Dallas, Texas, right? So you have a big real estate company, if you will. We refer to them as sponsors. They go out and they buy institutional quality real estate. It could be that multifamily. It could be a self-storage in Raleigh, North Carolina, a medical office building in Orlando, Florida, you name it. Different sectors, different sizes, different locations. And so so these big real estate companies buy these deals, and they turn around and they offer it to retail investors like you and I, and provide that turnkey 1031 exchange replacement property option. And so again, in the spirit of folks that are tired of active management, or maybe they're not tired of active management and they just can't meet their 45-day ID period, right? Maybe they just can't satisfy the exchange. These DSTs, which can be an individual property in one DST, or the trust can own a bunch of properties within the DST. They're already owned, they're occupied, they're stabilized, they're income producing. Some have debt, some don't have debt. And you can roll right into them. And so I'll just give you an example. And going back to actually the 499 investors, that allows for lower minimums, right? So I could take little Mrs. Smith, who's 75 years old. She's selling a duplex or a triplex in Orange County or Texas or wherever it may be. She's $2 million. What are her options, right? She can either not do an exchange and pay, I'm making this up, $600,000 in taxes. She can do an exchange and buy another property on her own, or which most cases doesn't solve like her problem being she doesn't want to manage it anymore, I get phone calls. Or she could go and look at DSTs, and I could take her $2 million and diversify that $2 million across we'll call it 5-6 different opportunities. Again, that multifamily in Texas, the medical office in Orlando, Florida, the storage in Raleigh, North Carolina, and mineral rights in the Permian Basin, so on and so forth.
Yeah.
So it's a very powerful vehicle or investment structure that really is appealing to the older demographics across the country. I'll stop there.
Yeah, I was going to say, so you're not really trying to call the market or say, hey, self-storage is the best, or this apartment complex in Texas or medical. You're just kind of looking at and I guess just looking at different asset classes, I guess, to diversify.
100%. Look, our clients our clients are trying to protect what they have, right? And most of them have already made money for the most part. So I always say, look, they're not investing to get rich anymore. They're investing to stay rich.
Right.
And so we are just building diversified portfolios to mitigate risk. And going back on my experience, there's 100 different offerings in this market at any given time.
Yeah.
And the most sophisticated real estate investors or attorneys or CPAs, they walk into this space,
Yeah.
they have no idea how to assess these offerings. It's a different world.
Yeah.
And I lived in that world, and I built these products, and I know these companies. And so that's what we do, is we help investors navigate this market, and really invest in what we believe to be the strongest, most durable, safe opportunities.
Okay, let me ask you this though, because I mean, anybody can say yes to a deal. It's easy, and you just get, oh yeah, done. Hey, what's the last deal you turned down, or what kind of deals do you turn down for your? Because I mean, there's a lot of deals out there, and there's got to be some bad deals. What's a bad deal look like?
Horrible. And I always say, this is the wild, wild west out here. I don't know how it is in your space, but you got lots of sponsors, right? The big real estate companies, lots of different offerings.
Yeah.
And so there's so many things that go into it beyond just the real estate itself, right? I mean, naturally you think, okay, well, is the property a good location? What are the fundamentals or demographic fundamentals? Job growth, rent growth, supply, demand. That's just the tip of the iceberg. Of course, you've got to look at the company's track record and history. You have to know and understand the fee structure, and it's not like just documented in such a way where it's easily digestible.
Right.
You have to understand, okay, are the numbers that they are providing in terms of the pro forma, are they realistic, right? Are they covering the distribution from real estate operations that they're telling you that they're going to pay, right? If they're going to pay you a 7, it sounds great, but what if they can't support the 7? And what's going to happen then? And that happens all the time. And and unfortunately, I call this channel the channel of counterintuitive investing, and I don't mean that disparagingly to investors, but oftentimes they are chasing yield, right? They're getting sold by a salesman who just wants to close a transaction,
right?
And that is the problem in probably every industry, and we're not immune to it either. So that's what we do. It's so the deals that we've turned down, there's 100 deals at any given time on average. We don't even look at 70 of the 100 on average. Yeah. Why? Because I know the CEOs on down for most of these companies, because I used to work with them. I know whether they're how much due diligence they're doing, whether they're focused on their bottom line or they're truly prudent stewards of investor capital.
Right.
The management teams, how they operate. And so there's lots of variables, but yes, we don't offer many. And with that said, I have to say this, I don't have a crystal ball either. I'm not going to be 100% right every time. And we've had deals that aren't performing. But what I can assure you is that, we're able to mitigate risks significantly, helping investors avoid the potential nightmares, and keeping them close to those folks that really do care about investors and have the dry powder and the capitalization, the wherewithal to survive, whatever economic challenges you may have.
That's true. I mean, I wrote the book, The Upside of Oil and Gas Investing, and the reason why I wrote the book, and Forbes has, published it, whatever. I mean, I wrote it because I don't think I have one here, but I'll be glad to send you one, Ben. But the reason why I wrote it is because I wanted for people to know, hey, you know what? All the sponsors or promoters or whatever you call them, I mean, they get into this business all for the same reason. I mean, they don't want to have to find new investors every month. They'd like to find 100 investors, and they're all investing. They're all happy. They send them Christmas cards and champagne. And I mean, it's everybody's real happy, So, but what happens is when there's some people out there that just don't know how to manage or control or drill or complete. It's like there's some, and the structure And the structure of some deals that we've seen in the oil and gas industry, it doesn't matter. It doesn't matter how good a guy you are, how good a guy. It's like, man, your deal is structured for disaster. You know what I'm saying?
Right.
It's like there's
Absolutely.
no way that you're ever going to make any money, even though the sponsor, promoter, or whatever just says, man, I'll tell you what, I love you, Mr. Investor, and I want you to come back to me every day, every week, every month, and I want you to. I mean, they're praising and all this stuff, but they have no clue that well would have to be like a giant, you know, the giant in the movie Giant, James Dean. You know, the oil goes over, which you know, my grandparents and great grandparents have been there on those kind of wells, but that's the kind of well that would have to, which doesn't happen, but that's the kind of returns you'd have to have. So I think that's one of the biggest things in seeing you and your experience and what you have and what you bring to the table is because you've been in it 20 years. You worked for a lot of the CEOs and know the companies and you've seen deals that you know. I mean, hey, if you see a deal, I know a deal, and let's say I could name him right now. I don't want to do it on air, but may get in trouble. But if I see a deal from XYZ, I know I'm gonna throw in the trash.
100%.
Yeah,
right?
they don't know. They don't have a clue. All they care about is themselves. All they care about selling deals, and it's there's so many fees in it. There's the deal may be okay, you know, because it's shiny, whatever. But the deal is like there's no way. Period. They charge too much money up front. There's too much money up front. There's too much management fee. There's too much all the other things.
I call them, look, there are deals that are built to be sold and there are deals that are built to perform, right?
Right.
And that's exactly what you just touched on. And it disgusts me, frankly, because most of these bad actors, if you will, they're preying on the unsuspecting, and most of them on the elderly, right? I mean,
right.
You go back to 2000 well, sorry, I was going between thoughts. You know, look, when I got into space, you asked this earlier, Jay.
All successful people have ADD. You know, ADD is fine with everybody. Go right ahead. Go right ahead.
I apologize. You know, in 2006, you asked like what your experience, the good and the bad, whatever. In 2006, I was a spring chicken right out of school. I didn't know what the heck I was doing.
Mm-hmm.
And I thought, well, I jumped in there. I jumped into this business. I thought it was the best thing ever. I mean, our biggest problem was making sure the fax machine was full of paper because, you know, there was so much business coming in.
Mm-hmm.
And then the party stopped in 2008, 2009. And it was a blessing in disguise for me because I'm like, here, you know, spring chicken, I'm just taking orders. But so many people got destroyed. And that was a wake up call for me. And I, you know, immediately I was like, look, I need to understand these deals. I need to understand what's going on. I can't just be selling a pipe dream or some shiny building. I need to figure it out. And that was the best, it was a great moment or time for me in retrospect. And so everything that you're saying is spot on. And really, it's about trust, right? You have to find somebody that you can trust. And it's hard to do that today. Yeah. It's really difficult to find somebody. You don't know. Yeah. Until And so anyway, there was a lot of stuttering and a lot of ADD for not a whole lot, but hopefully it made some point.
I understand it. I mean, truly, because it's like you don't want to talk about how bad things were or how bad you've seen things or people or whatever the case may be, but it's like there's so much truth in that. It's like, hey, I know that if I go to Jay Young for an oil and gas deal, I'm gonna get a fair deal. You know, it may not work out. I've seen, but in four generations, I've seen the ups and downs. I know the ups and downs are coming. I know that. So how do we mitigate that the most? And 5 years, 10 years, 15 years ago, 20 years, I'm getting better every day, every time. I'm getting better, you know. And it's still not perfect, but I know what I can do and what I can't do. But there's some people out there that just haven't weathered that storm yet, or they don't have the experience, or they're just trying to. They don't have any morals. I mean, there's some people out there
They don't
literally
care. Exactly.
It's like, hey, if the client makes money, fine. I don't care. I just got to pay my rent, or whatever, and unfortunate that there's those deals out there. I wish they were closed down. And that's the reason why I wrote the book, was because, hey, if somebody ever saw my book, The Upside of Oil and Gas Investing, they know that, hey, you know what? I know what a good deal is. I know what a bad deal is. And it's not going to be perfect, but you know what? I'm going to do the best I can for the client at any time. And I'm not going to give up, period. I could have given up in Fund 1 on one of our projects. I didn't give up, even though we did some deals that were riskier than they're riskier than we should have. I shouldn't have put so much money into those. I should have stopped and went somewhere else, which we live and learn. No guarantees.
I commend you, because there's not many folks that will just come out and say that, right? It's all about just be honest, right? You made some mistakes. You can go back and you wish you would have done this, but you've learned from it. But your heart was in the right place,
right?
And now 20 years down the road, you're that much sharper, and that's what it's all about. Folks that tell you, it's going to be a home run every time, that's where you want to run. Right. It's even great deals that we bring to the table could go wrong.
Yeah.
Right. It could go wrong.
Yeah.
And it's just about being transparent and honest.
But if it's a great deal and there's a bad market, you can get out of it. But if it's a so-so deal and it's a so-so deal and you have a bad market, clients lose everything, and that's what I've learned a lot here lately, and what I've learned, and we're trying to work a deal right now on a sand mine out near New Hobbs, New Mexico, and it's an incredible deal. And I could be blind and just go, oh yeah, it's perfect. Let's just overpay for it. Let's just think through the whole thing and ask our 19 due diligence questions, and making sure that, hey, well, okay, so what if this happens? Or I called a friend of mine, mentor, and said, hey, what do you think? And he goes, hey, well, let me tell you what I think, and then you can go back and renegotiate. I'm not trying to renegotiate. I'm just trying to say, hey, what if this? I want to be long term in this business, and I'd love to sit, 10 years from now, clients are still receiving 20, 30%, or we sold it, we're out of the deal. And the ADD that I came up with, ADD squared, was, hey, you know what? Our ADD is acquire, develop, and divest, instead of the ADD that Adderall or whatever that. But attention deficit. My ADD is acquire, develop, and divest, and I say ADD squared because I may get it up going and sell off enough of it to where clients get their money back and everybody's happy, and then we could sell again in the future. So, but a bad deal or a bad operator, a bad sponsor, it's like you can't. Hey, I'm sorry. So you need to do your due diligence. What do you look for in due diligence? Okay, you said track record. Is there anything else in particular?
I mean, that's basic. You're right. That's track record is basic. Yeah. Is there anything in particular? Yeah. I mean, of course, their experience, right? You want to get in bed with. I mean, it could be a nice gentleman or lady that's in the mineral rights business, but they're 2 years in, right? They don't have the 20 years that you have, right? That's important.
Yeah.
Do they? Is there, brand reputation that they want to protect? For example, like I know some of the groups that we work with, they're huge companies. The last thing they want is for one of these investments to go bad and tarnish their reputation, right? So that's almost, skin in the game. But on that note, I also want skin in the game, right? I want deals where the sponsor has real money in the game, right? Yeah. Then your interests are aligned. That is among the most important things that I look for. If they don't have skin in the game, there's no connection. That's a problem, right?
Yeah. I like that.
Go ahead.
Yeah, I was gonna say skin in the game, but also too, tell me about a deal that went bad that you helped, or what's, it's kind of like when you're interviewing somebody. I always like, because I mean, when you're interviewing somebody, we interviewed two people this week, and it's like, oh yeah, well man, I did this. Hey, tell me something that went wrong, and how did you get out of it?
Yeah.
You know what I'm saying? Something like that.
Well, out of it. So most of our deals, most of our offerings, the vast majority are illiquid,
Yeah.
right? So for a period of time, 5 to 7 years. So there's not a whole lot of wiggle room in terms of getting out. And I'm just thinking, if I want to say it. So there's not a whole lot of wiggle room in terms of getting out. But I'll say that we nip things in the bud, or try to the best of our ability,
Mm-hmm.
on the front end. And I'm trying to think of, and again, whether it's through let's see, I'm thinking of a deal we had in Jacksonville, and there was this, the income was awesome, the deal was beautiful, but then there was this rent or tax abatement in place for 5 years. And it was that tax abatement that made the deal look so sweet.
Mm-hmm.
And then, most again, advisors and investors, they don't look at the end game, right? So we're looking at, not only does it make sense today, but then how are you going to sell this in 5 or 10 years, whatever it may be? And so that's, we're looking into that, and we find this rent or tax abatement that is really not disclosed in such a way where we felt it should be, which is always a red flag. So that took us down a deeper rabbit hole. And lo and behold, if you back out that abatement after the end of year 5, you're screwed. I mean, investors are going to get back 75 cents in the dollar if they're lucky. Right? That's just one example. So most of it has to be nipped in the bud on the front end.
Right.
And those types of things. Hopefully that gave you an example, Jay.
Yeah, that's good. I like that. Well, because that's something that you see when the deal goes bad. It's like some people just throw in the towel and go, man, I'm out. I'm going to go back on my boat, or I'm going to do whatever. And hey, we just have to chalk that up to a bad one. Or you keep, people talk about, one of the things about me is, I'm definitely persistent. I'm not going to give up. I won't give up on anything, especially when clients have their money in. And I have my own money in deals too. I mean, we had a deal go bad, and I said, somebody was talking to us, I said, hey, I gave up. I have money in the game. I had $600,000 in the deal, number one. Number two is I gave up all my carries in the deal. So hey, I hope this deal works out. But not only did I not make any money on the deal, and I put all my money in the deal, but also I don't have any carry. So it's like, hey, we're all in this thing together. Like you said.
And that's the other thing that we do, and it's not because it's not when deals are struggling.
Yeah.
Right. I think there's like some advisors are just passive.
Yeah.
Well, not us. I mean, we go back. Well, look, if you fail to do this and you're underperforming here, well, you're going to share in this pain too. Reduce your asset management fee. Reduce your property management fee. This isn't if you want our business and you want our support, you're going to do right by our investors. If you don't, then we're never going to do business, and we will spread like wildfire throughout the community that you're not taking care of investors.
Yeah.
So we're very active.
Yeah.
Sometimes almost to a fault, but
yeah.
But
no, it's true. It's true. One and done. We've had those kind of people we've dealt with before, and it's like this is our one and done deal. We're going to do one deal and that's it. We're moving on, and wish you the best of luck, and hopefully we'll make some money off this thing in the future. But it is. So have you ever done a real estate or an oil and gas deal before? Have you looked at our deal? Where did I find you, or where did you come from?
I think Mr. John Hold'em introduced us, and he was a podcast kind of agent, if you will.
Oh, okay.
And honestly, I mean, you start at 7 a.m. I'm on the west, or you start at what, 9? I'm on the west, or no, 10. I'm on the west coast.
You're on the west coast, so it was 7 a.m. this morning.
Yeah, it came across my desk, and I said, oil and gas. Like, I love mineral rights. I'm so into it. I want to talk to this gentleman and his audience. So
Good.
that's, we just got
Okay.
connected that way.
Well, I appreciate that. I was looking out your window, and man, it's beautiful over there. I'm like, man, this guy's living large somewhere where it's looking beautiful outside. It's not that like that outside my window. If you can see outside my window,
No,
it
I
is
can't. No,
cold.
it's
It
nice.
is a cold day in Dallas, Texas today. But
Oh,
anyway,
okay.
no, it's good.
Yeah,
Well, I'd like for you to look at our product sometime and see if our clients have an interest.
absolutely.
And man, I'm really pumped up right now about Fund 3 that we have, because Fund 3 is is in an area we have different assets that we're drilling, and we also have the sand. The sand that was going to be it's going to be beautiful. It really is. And
I don't know anything about that, so I'm gonna have to talk to you offline, I guess, about
oh,
the sand.
hey, I'd love to talk about it, man. I am just absolutely 100% pumped, and I don't think I'm supposed to advertise on the Jay Young Show our deal
Yeah.
or something. I don't know,
I,
but hey, the returns are, I mean, if we can hit anything close to what I feel like that we can do, it's an incredible return for clients, and that's what I want to do is spread in some drilling, have the 100% write-off for clients, which in California, man, they love write-offs. They love write-offs out there, no question. And
me, yeah.
number one, but number two is the monthly income, but also that increase the value to sell it in the future. And our project is just incredible, and I love it, and I believe in it, and I'm investing in it wholeheartedly, and we're putting a different twist to it, which I've got to work on that today, because we're going to have something that goes out. I'll make sure you get a copy of the flyer
Please, yeah.
sheet that we have, and but man, it's just something that it's oil and gas related, and it's going to be really good because it is oil and gas related, but it's also, I'm taking my whole entire career that I've done, and I'm 62 years old, and
Wow.
and I went to Cabo when I was 62 on my birthday. My 62nd birthday, I was 30 years sober, and I hit a hole in one, all in the same couple of days there. So
Wow.
that was pretty cool.
The good Lord working for you. That's
Oh,
amazing.
hey, amen on
Congrats.
that, man. No question about it. And I read my Bible this morning from 6:30 to 7. But I'm just saying that you find a good product, a good sponsor, and sometimes it's timing. Everything is timing, and I really feel like that it's a great project. I'd like to talk to you more about it offline. But anybody else that has any clients or anybody that's interested in something like this, I don't do the Jay Young Show to advertise our oil and gas programs, because I want to make sure that this is inspirational. This is faith driven. It's about motivation. It's about trying to help other people. I like the 16 to 22-year-olds because I want them to understand what it's like and what it's like to be in the real estate business or the oil and gas business or other. And I've interviewed hundreds of people, and I'll continue to interview lots of people that give them life experiences, and because hey, if I mean, I grew up in a small town, right? I mean, I grew up in a small town. My grandfather's in the oil business, and my other grandfather was in the retail business, and I didn't really have a lot of people that I could go and talk to and say, hey, what should I do for a living? You know, so that's why I like the idea of the Jay Young Show. And
That's amazing. More people like you should be doing this.
yeah,
Um, yeah, that's absolutely that's powerful.
hey, great.
Really.
Well, I'll tell you what, Ben, I got to roll. Let's just
Yep.
let's end. Oh, I'm sorry. So I normally have a co-host, Jordan Soto, and Jordan always asks at the end of the show to all our guests, "Hey, what if you were 18 again?" I forget how the hell she says it.
Yeah,
But
yeah.
if you were 18, what would you tell your younger self, or whatever? So what? Give us that one
Right.
powerful Ben Carmona. If you were 18 again, what would you do different? What would you tell yourself?
What I do different. What I do. Um, I think. Well, I know. I wish I would have gone out on my own sooner than I did. It takes a lot of courage and guts, and it's so
Yeah,
scary to break away from what is, the day to day, the norm. And I wish I would have just taken the leap of faith and had more belief in myself and not so much fear at that time. I mean, it was 37 years old when I did it.
Mm-hmm.
So for the 18-year-old, I would say believe, right? Trusted God. If your heart is right, you can do anything.
Yeah.
And so I would say go early, go sooner. Yeah.
Yeah.
And believe.
That's great.
That's honestly what I'd say.
That's great. I love that. I love that. That's great. Because I mean, it is. It's all about God. It's about putting your trust in God. Learning, educational. I mean, I spent a lot of time drinking, and I spent a lot of time in bars and things of that nature when I was younger. And I guarantee you, I didn't have anything to do. That had nothing to do except set me back further than it would have if I would have been in a better job, and I cared more about my family and my God more than being there chasing women or whatever the case may be.
Amen. That's the most powerful message we could on this whole podcast. That's the most powerful message. Agreed.
I agree.
So thank you so much, Jay. I really appreciate your time.
Man,
I look forward to talking to you offline.
Man, this has been awesome, dude. It's been awesome. I really enjoyed this. This is really good, and I appreciate you bringing the faith in, the educational, the experiences, and all that. Man, this has been awesome, and people are going to learn from this. I guarantee you, we're going to have a lot of people learn from this. So, Ben, thank you very much for being on the show. I look forward to connecting again. Everybody out there, appreciate you being here today. Ben's been incredible. You're going to learn from him, and I look forward to reconnecting with him offline, but also bringing you new stories just like this. Thanks, and have a great week.
Thanks, Jay.